Hello, everyone. Welcome back. And there's a bunch of updates on the macro picture that I wanted to share with everyone here. And the topic remains the same as what we've been, looking at and discussing and walking through for the past many months now. And that is, despite the price action being very bullish on the market, on NASDAQ, technology stocks, and many other parts of the economy and the market, despite the bullish price action, leading indicators continue to point to recession. So there is a widening disparity between prices and economic data, especially leading economic data. So I still believe, despite the strength of the market, that we are entering recession. And I know that's a contrarian call. And it's very unpopular to say that or to push that narrative, despite the fact that the market has been so strong year to date. But I'm just here to kind of present the data to you so that you have all available information to make an informed decision in your investment process. So it's important to consider not just price action, but also economic trends that have a strong implication on earnings. And ultimately, it's earnings that the market tracks in the long run. So let's take a look at some of these data points that directly impacts earnings in my view. So here's just a brief summary on the bear case that I've been presenting here. And I'll just briefly hit up the bold points. You can obviously read the sub points underneath that. But U.S. manufacturing remains in recession. We are starting to see the beginnings of rising unemployment. I know that certain numbers are coming in pretty strong here. Initial claims actually did tick down this past week, but if you look at it on a 4-week moving average, that number is at multi-month highs and it's trending up. So the general trend is up. And you can also see that with other measures of unemployment, such as permanent job losses. We have and continue to have an inverted yield curve. That's the 10-year yield minus the 2-year yield. Also, another yield curve that I like to look at is the 2-year yield minus the Fed funds rate. That number is also inverted. And every time we've had an inverted yield curve, that's been a pretty strong indication that the economy is under stress or increasing levels of stress, and that usually precipitates a recession. Real retail sales are actually down 2.4% year over year in the latest read. That only happens in recession or at the start of a recession. Real gross domestic income has gone negative. This is the other side of the equation of GDP. Everybody talks about real GDP, that takes all the headlines, but real gross domestic income, which is the income side of the equation, remember GDP measures production, and GDI measures the income that production generates. And they're usually exactly the same. There's usually never a discrepancy between the two. That's why nobody ever talks about real GDI. And it's because real GDI is always roughly the same as real GDP. There's almost never a spread or a discrepancy between the two, but right now there is. So that number has actually gone negative year over year, and that only happens in recessions or at the start of a recession. So this discrepancy cannot persist. Ultimately, real GDP will follow real GDI, or vice versa. One of the two have to happen. And my bet is that, in the context of all these other, items that I'm talking about here, real GDP will catch down to real GDI. That's just my personal opinion. But remember, this never, goes negative year over year in the absence of recession. And we'll take a look at all of these in chart form in just a few minutes here. The Conference Board's leading economic index has now been in deep contraction for 13 consecutive months now. That never happens in the absence of recession. And then on top of all of this, banks remain under a lot of pressure. You have multiple things happening simultaneously. You have depositors withdrawing at a pace of $2 billion. It says $1 billion, but that's a typo. Should be $2 billion per day on average for the past 15 months. That's been the pace of withdrawals, because now with the Fed funds rate at 5.25%, why would anybody keep money at banks? This is just a common sense question. Why would you keep your money in a checking account, except for the bare minimum that you need to pay your bills? All excess savings really ought to go into money market mutual funds, or ETFs that track treasuries one way or another, instead of sitting in banks, right? Because for years and years we were all used to having 0% deposit rates because the Fed funds rate was at 0, but now it's at 5.25%, which now is well in excess of the rate of inflation. So now you're earning a very large real yield on putting money into a money market mutual fund or other types of short-term, low-risk, bond funds. So, and so for good reason, depositors are withdrawing money from U.S. banks. That's putting a lot of pressure on banks to come up with that liquidity to be able to meet those withdrawals. In addition to banks also posting rising loan loss reserves. Remember, this is the contra indicator where this directly impacts bank earnings, because as they put aside additional money in preparation for rising default rates, for example, that loan loss provision is basically banks increasing their expectations of bad debts, I should say. And that's been increasing. That typically only happens as a feature of recessions. And it's now at, the highest levels since 2020, but, prior to that, back to 2007, 2008. At the same time, commercial real estate prices are rolling over. We've seen actually a number of articles in the Financial Times and Bloomberg and other media outlets talking about this. It's also famously Charlie Munger, in a recent interview, also expressed a lot of concern over this. And so this will put pressure on banks that have exposure to commercial real estate. So this is just one of many things happening simultaneously. So all of this compounds the ongoing issue that almost all banks are facing, which is that they have large unrealized losses on their held-to-maturity Treasury securities. We've already seen that, front and center with the epic collapse of Silicon Valley Bank, of PacWest, and of Signature Bank. All of them, basically going into distress and basically going under because they simply couldn't keep up with both depositor withdrawals and having large unrealized losses. So that would mean that they're forced to sell at a loss in order to meet those withdrawal requests. Now, the Fed has created a facility for them to be able to borrow. But remember, this is all happening, together. It's not just one, but it's a combination of all of these things here together that's putting tremendous pressure on banks. And that's why you can see in Zacks, in ZRS, you can see that, analysts are slashing their earnings forecasts for banks quite dramatically. And again, all of this is pointing to tightening credit availability. And this is one of the sources of growth for the S&P aggregate, right? So this is not limited to just banks. Not only when banks suffer, it's not just limited to them. Remember, the banks are they provide the plumbing for the entire U.S. economy. And so when they have to pull back on extending credit, that affects everybody throughout the entire economy. So when there's tightening credit availability, that freezes liquidity. And when liquidity freezes, earnings across the S&P 500 are hit. And so that's exactly what's happening. For the S&P 500, we now see new lows in the earnings estimate revisions for the S&P 500, not just for banks, but for the S&P aggregate. And all of this together, unlike past market environments where the Fed has been there, The Fed is not supportive of stocks right now and won't be until we see a sizable decline. Jay Powell has been very clear that they're not interested, nor are they even afraid of recession. Jay Powell has been very clear that their front and center focus is getting inflation back to their long-term target of 2%. So they're not afraid of rising unemployment. They're not afraid of a mild recession. What they are afraid of is a deep recession, or a disorderly, blow up. For example, if more banks go under, that would be something that they are afraid of. But what they're not afraid of is rising unemployment. What they're not afraid of is a downtick in earnings. What they're not afraid of is a downtick in stock prices. What they are more afraid of is inflation that cannot be contained. So that's been very clear that that's their focus right now. So, if the market rolled over 10 or 20%, they're not afraid of that. That's not what they, I don't think Jay Powell is really afraid of the market declining by 10 or 20%. What they want is inflation back into the bottle. Get that genie back into the bottle, and that's what they want. And it's been very clear that they're not supportive of stocks right now. So unlike past market environments, this is a very different environment. The Fed won't be there to just immediately cut rates at the first sign of distress. And that's not what's going to happen. A lot of people think that the Fed is going to be there, but they won't be, in my view. So right now, why is the market so strong? It's because they're pricing in that earnings trough. As you can see, as we shift into 2023, what happens is that forward earnings per share forecast rolls into 2024. And right now, analysts are still bullish on 2024 recovery. 2023 is basically a lost cause at this point. But now that we're halfway through it, the market is looking into 2024. And that's why you see this recovery in the market, because you can see this trough, pretty clearly here. So as long as 2024 estimates remain elevated versus 2023, you'll see a pretty strong bid underneath the market. But my contention is that this trend is going to continue. And as you can see here, analysts are beginning to cut 2024 forecasts. We saw a pretty strong cut, late last year, basically in the second half of last year. But then look what we saw here, a stabilization of earnings per share estimates for the S&P. You can see from, the end of, basically from January through, May, earnings estimates were stable. But look what's happening now. That cut is starting to resume here. It's only a penny from the lows here, from 631 to 630. It's only a penny, but I believe that the leading indicators of earnings, which is what we're going to see here in just a second, continue to point towards deeper cuts to earnings expectations. So I believe that fiscal year 2024 EPS estimates will continue to be marked down significantly. Not just slightly, but significantly. Why? Well, we can see leading indicators of earnings continue to point towards recessionary levels. Just this morning, we got an update from the Chicago PMI. Yet another very, very bad print at 41.5. This measures it measures manufacturing activity in the Rust Belt in the Midwest of the U.S. And the reason why this is important is that it shares a very strong correlation to S&P earnings growth. And you can see that it still remains in deep contraction. This is the 10th consecutive month in contraction. It's one thing to have contraction for a month or two, or even 3. But this is now 10 consecutive months in contraction. The longer this remains in contraction, the greater the chances of S&P earnings growth continuing to come down. And you can see that strong relationship here. And I've been saying this for, almost, 10 months now, dating back to September, that S&P earnings growth is going to come down. And that's exactly what has happened. Now that the Chicago PMI, peaked, in that nosebleed inflationary post-COVID environment, we've now reversed that entire sort of, overshoot well above the mean to now well below the mean, below trend. And that's why you can see here for 10 consecutive months, we're in decline. The longer this remains to be the case, we are going to see weaker and weaker S&P earnings growth as we progress into 2023, in the second half of 2023 and into 2024. So this will continue to weigh. Here's the other thing that I was talking about. Real GDI is now negative. This only occurs during recessions. You can see here, real GDI, that's gross domestic income. This only goes negative during recessions, as you can see here. We never have a negative print in a non-recessionary environment, going back, 5 recessions. This never happens in the absence of a recession. Now, many people will say, well, this is just a mean reversion because we had a very strong, 10 to 11%, print. So we're just getting back to, mean reversion. That's not the case because that 10% or 11% growth is in the context of a very depressed base of minus 6%, in response to COVID. So you can see that, most of that is just a reversal of the COVID drop. And now we've mostly cycled out of that. And now we're in, negative territory here. So we're now below trend on real GDI in absolute dollar terms. So this again points to recession. The ratio of real GDI to real GDP is now at lowest levels since 2008. So this never goes inverted, meaning below 1. You can see that it really dances around 1 for most of the time, but it only goes negative really during recessions. That's the only time it really goes negative here. And that's where we're at right now. The Philadelphia Fed Manufacturing Index, that's at recessionary levels. So anytime it's had a reading below 25, we've been in recession, going back the last 8 recessions with no false positives. ISM Manufacturing, similarly, at the lowest levels since really 2009, with the exception of, the COVID drop. Same thing with the New York State. This is the Empire State Index. This is at basically 20 years lows, excluding COVID. This is on the demand side. So this is pointing to where is demand coming in. ISM Manufacturing new orders. This is again at the lowest levels going back to 2008, 2009, excluding COVID. So this is on the demand side. Demand is very clearly waning. You can see here, this is the hourly, weekly hours on average in the manufacturing sector. And you can see that within manufacturing, hours are being cut really to the lowest levels since 2008, 2009, with the exception of COVID. We never actually got back to the pre-COVID levels, by the way. That never really made it there. And now we're rolling over again. And then, of course, we have deeply inverted yield curve. This, again, we've never had an inversion in the absence of a recession shortly thereafter. So, on average, this kind of, predicts a recession 1 year in advance. And we're really coming up on that 1 year anniversary, from the moment that it goes below 0. So I think that this is starting to get close to recession. Also, the Conference Board publishes the leading economic index. That's been in decline for 14 consecutive months. That's at recessionary levels again. So these are indicators that are not typical for bull markets. You don't really see this in a typical bull market. These types of trends are not what we see in a strong bull market. Here's the 2-year yield minus the Fed funds rate. This is deeply negative, and history has shown that when the Fed forces inversion, meaning it goes well above what the 2-year yield is telling us. Remember, the 2-year yield is a great sort of balance between what the Fed wants and what the market wants. Market interest rates, right? It's a hybrid between the Fed at the very short term and the market. And that gives you an idea, with the 2-year yield. Whenever this number goes negative, we've entered recession, in the not too distant future. So this has an even more near-term sort of predictive power than the 10s minus 2s. And we've been now inverted now for many months here. So this is telling us that the market doesn't like the fact that the Fed is at 5.25%. So when that happens, history shows that something tends to break. And I think that it could be banks. I'm not sure exactly, but I think that banks are very vulnerable. They continue to face a lot of difficulty because we have, these four things happening simultaneously. We have banks, sitting on large unrealized losses because they bought a lot of treasuries back when the 10-year yield was at 1.5%. Now the 10-year yield is at 3.5%, possibly going to 4%. So those are very large losses that they're sitting on. Now they will reverse, but it's going to take many years for that to happen. So they may not have that much time because you have increasing depositor withdrawals. You have declining commercial real estate prices. That has to do with their loan book. So, and then they also have rising loan loss provisions. They're marking, bad debts higher and higher. So if you combine these four, undercurrents here, that basically means tightening credit availability. So here's that deposits chart. You can see that deposits continue to come down. It really accelerated, back when Silicon Valley Bank went under. So that's starting to kind of, put pressure on banks' perceived solvency. And you can see that started to happen. Now it really stabilized since then. But I believe this is going to continue to come down because as banks continue to not be able to keep up with the Fed funds rate, it just makes no sense for people to keep money in a bank. So on average, $2 billion has been withdrawn every single day from U.S. banks since the Fed started raising rates. At the same time, loan loss provisions are rising. You can see that here. So this has been the biggest uptick. Now, it's off of a very low base, but this is an aggregate number. So this is not a percentage change year over year. This is the total, in terms of dollar amounts. So this is in millions of dollars. So we're at roughly $20.7 billion in provisions for loan and lease losses. This is basically the highest levels that we've seen since, basically COVID, but prior to that, in response to the 2008-2009 crisis. And the net result is, again, tightening credit availability. So this is directly from the Fed. You can see that a record 50% of respondents from the survey have reported that they are tightening credit standards for commercial and industrial loans. Again, when this happens, credit tightens, and therefore that halts earnings growth for the S&P aggregate. You can see that this is the highest levels that we have seen since 2008, excluding COVID, 2020. So again, you can see here that the only times credit gets tight like this is during recessions. 2000, 2001, 2008, 2009, and 2020. The combination of all of this is basically resulting in this right here. Very deep cuts to bank earnings. And this doesn't have any signs of abating. You can see that, just this past week, the forecast for the XLF ETF on average continues to sink. $7.03 for this year, $7.60. Now, it is expecting a strong recovery for next year, but the rate of change continues to be down, and I believe that this is going to continue given all of the forward indicators for S&P earnings growth. Inflation continues to come down. We just saw this morning, PCE registered, 3.8%. This is a chart of CPI. We're at 4% on the latest read here for the month of May. But just this morning, we got PCE, and that's down to 3.8 versus 4.3 for the prior month. So the rate of change of inflation continues to come down, and it's because backlog is coming down and remains in deep contraction here. So whatever backlog that was created in response to COVID during that supply chain shock has now mostly been essentially reversed. And backlog is basically cleared out at this point. This means that the longer this stays in contraction, this means that we're going to see a cut to production in manufacturing activity. Because if demand doesn't pick up again, manufacturing is going to get cut in terms of production. And when production gets cut, so does GDP. And that's, these are all the leading indicators to production, in my view. So backlog is cleared. New orders, as we saw in a prior slide, is at deep contraction. So if demand does not pick back up, you're going to see cuts to production and therefore a cut to manufacturing hours, and layoffs within the manufacturing sector accelerate. Key commodities have returned to normal ranges. You can see crude oil is basically back to normal ranges, wheat, lumber, all back to normal ranges for the past 20 to 25 years. Natural gas, very cheap at this point. The Fed continues to remove liquidity. M2 is down year over year for the first time in history. And this is basically the Fed getting this back to mean reversion here. They want to get it back to trend growth. That, again, is going to be a net negative on earnings, because as they remove liquidity, earnings continues to get hit. Housing prices beginning to crack. So again, the lower this number is, the lower the net wealth effect for consumers. That begins to hit other parts of the economy, like real retail sales. And you can see here, real retail sales are down year over year, 2.4%. Again, that only happens during recessions. And although unemployment is still low, it's at 3.7%, permanent job losses are trending up. So again, every time that this number has crossed over the 3-year moving average, we inevitably have entered recession. And we haven't had that happen yet. But keep in mind, COVID is skewing the moving average, up. So if you use 2019 as the watermark, then we're already above that level right now, as you can see here. Initial claims are also rising. Now, they actually ticked down this morning. But again, that number, because it's a weekly number, can be volatile. So it's best to use a 4-week moving average, for example. And so that number continues to trend up. And I believe that that's going to join all of these other forces that are pointing towards slowing growth, slowing demand, and therefore slowing production, tightening credit, and therefore further cuts to earnings expectations. Now, none of this would matter if stocks were priced for a recession. But remember, the forward PE on the S&P is well above 19 times. We're actually a touch below 20 PE. And every time we've been in a 5% interest rate environment, we've been way below that on a PE basis. So the last time we had a 5% interest rate, we were at a 14 or 15 or 16 PE. We're at almost 20 times today. And that's on lower forward earnings growth. So if we had higher growth, then that would actually justify a higher PE. But we don't at this point. And earnings are trending lower. So this to me indicates that we are substantially overshot to the upside here for the S&P. If we were priced for recession or even a mild recession, then this entire presentation would sound very different. But we're priced for a bull market. A 19 or 20 PE is a bull market PE when all of the indicators are pointing towards lower earnings growth. And you can see the trend of earnings growth continues to come down into negative territory. And again, as we saw in all of the prior slides here, all of the leading indicators to earnings are pointing towards lower earnings growth into the future. And another quick note on valuation, you can see here that at this point, the 1-year Treasury yield, sitting at 5% is now well above the S&P's free cash flow yield, well above that. And it's actually has now the widest margin since 2007. Look at the difference here. 5% 1-year yield, 3.8% free cash flow yield for the S&P 500. That's the widest spread we've seen since 2007, really. So it really doesn't pay to own stocks right now. If there was growth, you can actually justify a lower yield because of growth. But again, growth is coming down, and all the leading indicators for earnings, like the Chicago PMI, like ISM Manufacturing, like ISM Services, like the Philly Fed Index, all of these are trending down. And so I believe that with the combination of banks coming under duress here and credit tightening, you're going to see earnings get cut into 2024. Unless if these trends reverse real quick in the second half of this year, which they haven't so far as of, even this morning, we are going to see further cuts to 2024 earnings expectations. And so the market is currently not priced for a zero growth environment. It's being priced for a strong recovery environment. So if we don't get that, there's going to be a pretty nasty shock to the market. Here's another anecdote from the ISM services. You can see here that there's been a pullback in the rate of growth for the services sector. This is due mostly to the decrease in employment and continued improvements in delivery times, resulting in a decrease in supplier deliveries index and capacity, which are in many ways a product of sluggish demand. So again, production is caught up, which is good, but there's sluggish demand. So that's why delivery times have improved quite significantly. The majority of respondents indicate that business conditions are currently stable. However, there are concerns relative to the slowing economy. So again, this is not what we typically see in a bull market. You don't see sluggish demand or slowing economy, when the S&P is at a 20 PE, right? It just doesn't typically happen. FedEx just reported last week, and the CEO is announcing fresh cost cuts, again, layoffs essentially, which will support profit through the first half of 2024, but they are saying that this is an environment that we expect to remain marked by demand challenges. And remember, FedEx is important because they've got a pulse on, retail sales, right? Especially e-commerce. So when there are declining shipping volumes, that is an indication that, real retail sales are slowing, which will weigh on aggregate S&P earnings. Because remember, retail sales do carry a pretty strong correlation to aggregate S&P earnings growth. From a discounted earnings model standpoint, the S&P could be overvalued by almost 20%, 17 to 20%. This is assuming 7%, 6.25% long-term earnings growth and a roughly 7.8% discount rate. Now we can argue back and forth, whether that's a reasonable earnings growth number or not. But I believe in the short term, meaning over the next couple of years, this year, next year, and the year after, the compound earnings growth for the S&P will be roughly in that ballpark. 6.25%. So this is not even assuming any kind of deep recession or 2008 style crash. Even if you were to assume a mild recession, a low growth environment for this year and next year, followed by a modest recovery in 2025, you would see that the S&P is still quite dramatically overvalued here. So, and then again, the Shiller PE is another measure of what we might see in the future. This points to lackluster forward excess returns for the S&P 500. You can see that's had a pretty good, track record at predicting forward 10-year annualized returns. And now with the Shiller yield, this is the CAPE yield, at single digits, low single digits here, you can see that I believe that the forward 10-year, earnings, the forward 10-year returns on the market will continue to trend down into single digits, your low single digits. So that doesn't paint a very bullish, future. So my primary conclusion is that the direction of all of these leading fundamental indicators, leading economic indicators and leading earnings indicators at the margin implies negative pressure to S&P earnings. This means that analysts are going to mark down both this year and next year earnings forecasts. However, markets are priced for earnings recovery. So this is the key disparity here. If the market was priced for that, I would say, well, this doesn't matter because it's already priced in and it's okay to be long risk. However, markets are not expecting earnings to continue to be marked down. Now that we're at a PE of 19 to 20 times, that's a bull market PE, which is not characteristic of a 0 to negative growth environment. So if that doesn't happen, if we don't get a recovery next year, I believe there will be a substantial drawdown in the market. So again, my capital allocation, continues to be 1-year treasuries, which currently pays 5.25%, and a focus on defensive equities. So I would be in defensive stocks, meaning the Zacks earnings certain portfolio. Focus on the companies that have low Shiller PEs and have strong dividend growth and or share buybacks, right? Find those companies with, dividend growth so you get paid to wait low or modest or reasonable Shiller PEs. Therefore, you're not overpaying for that quality there. And just position for a low growth environment with a combination of those two. So these are the types of businesses we really like. These are, recession resistant companies that trade at reasonable long-term multiples here. And you can see exactly why we love these types of companies, because these earnings don't go through cycles. They're very, very recession resistant, I should say. So they're high quality businesses that continue to compound for secular reasons. So again, hope you found this helpful. If you have any questions or comments, or would like, if you have any feedback, or have a topic that you'd like me to cover in future webinars, let me know. You can reach us if you are a ZRS client at zrs@zacks.com, or if you are an advisor tool client at zat@zacks.com. Thanks everyone, and talk to you again in future webinars here. Take care. Bye.